Good afternoon. I wanted to send a video out and kind of educate everybody regarding what the Federal Reserve did yesterday. The Federal Reserve yesterday dropped their Fed funds rate by a quarter point. And sure enough, all the news media picked it up. All the different loan companies picked it up saying interest rate has dropped, interest rates have fallen, interest rates are all-time lows. This is misinformation. They're just trying to get you to do a little bit of clickbait here so that they can get you hook, line, and sinker. So I want to go over, first of all, what the Fed funds rate is, what are mortgage rates, and then finally, when is it a good time to refinance your loan? So first of all, let's talk about the Federal Reserve. Federal Reserve holds a whole ton of money. And what they do is they will lend money to lenders on or banks on a very, very short-term basis, typically less than 24 hours. So the Federal Reserve yesterday lowered their Fed funds rate by a quarter point. So the Fed funds rate is about 1.75. It actually fluctuates a little bit. So that means a big bank, U.S. Bank or Wells Fargo, has an extra $1 billion sitting around, and they can take that money and park it at the Federal Reserve for up to 24 hours. Well, why would you say they would do that? Well, maybe they have an extra $1 billion hanging around. They don't have nothing else better to do with it. So they're going to park it at the Federal Reserve, and they're going to get 1.75% on that money. Well, what the Federal Reserve wants is the Federal Reserve wants to stimulate the economy because they feel we are going into a recession. So to stimulate the economy, they want to prevent these big banks from parking money at the Federal Reserve. So last week, they could have parked their money at the Federal Reserve at 2%. Yesterday, they could park their money at the Federal Reserve at 1.75%. So, basic math, where would you park your money at? Would you rather park at the Federal Reserve for 1.75% or maybe do a car loan at 2.99%? So that's what the Federal Reserve is trying to do in order to stimulate the economy. They are preventing banks from parking their money at the Federal Reserve. And eventually, if you remember the Great Recession, we try to forget it, but let's remember it, where the Federal Reserve rate went down to zero. They didn't want anybody parking their money at Federal Reserve. They wanted all that money going out to do loans. And the loans that they're doing with this money is not mortgage loans. That is a whole different bond or aspect. They are wanting people to do, they do home equity lines of credit, but what they also want them to do is car loans, boat loans, RV loans, home improvement loans, but not a true mortgage loan. So when you hear the Federal Reserve is dropping rates, that does not directly influence our mortgage rates. It affects the Federal Reserve rates. What does affect our mortgage rates is the reason the Federal Reserve is dropping those rates. And the reason the Federal Reserve is dropping the rates is to hedge off a recession. Recession is obviously bad for the economy. So what happens is as the Federal Reserve drops rates, that indicates to everybody that we're heading towards a recession. And right now, the bet is we're going to have a recession in 2020. Now, we don't anticipate it being like the 2008 recession, more like the 1992, maybe 2005 recession. So as people talk about recession, more people will take their money out of stocks and put them into bonds. So if you have $100, you can do a couple things with it. You can put it in your mattress, which isn't really great. You don't get any return on that investment there. And actually through inflation, you actually get a reduction. You can buy commodities. You can buy oil, silver, platinum, or gold. You can put it into stocks or you can put it into bonds. So it's all about your risk. One of the bonds you can buy is a mortgage bond. And the more people that buy mortgage bonds, the price goes up and the rate goes down. So we really want people to buy mortgage bonds. So let's take a quick look at mortgage bonds. So let's talk about mortgage rates and how they go up and down. So let's talk about you have $100 and you can do a couple things with that $100. You can put it in the mattress as an investment, not a really great investment because inflation erodes that. You can buy stocks. You can buy commodities like gold and silver, or you can buy bonds. Each one has their pros and cons, and each one has their risks. The least risk is bonds. The highest risk right now is the stocks. So on a bond, you can buy lots of different bonds. State of Idaho sells bonds. The United States Treasury sells bonds. But the bond we are concerned about is called a mortgage-backed security or a mortgage bond. And mortgage bonds are influenced by people. You and I buy bonds. More people that buy bonds, the price of the bond goes up, but the interest rate goes down. And people buy bonds based off of risk. As we start going into this recession, more and more people are going to buy a more secure investment, as in bonds. So let's take a look at bonds in the mortgage market. This is the chart that we follow religiously on a day in, day out basis. And a little bit about this chart. First of all, it's an inverted chart, which means as this line goes up, interest rates go down. Also, green is good, red is bad. And then we have some Japanese candlesticks on here. Not going to get into that for you. We can see over the last quarter, this is June 26th, through September 4th, this chart has gone up, which means rates have been going down. Then, beginning September 5th through September 13th, interest rates have gone up. And actually, interest rates went up quite dramatically over the last 2 weeks. So when you hear the news media saying, ooh, rates dropped, and I heard it just last Friday's rates dropped again, they're always about 2 weeks behind on the data. So last week, interest rates worsened by about 30 basis points, or a third of an interest rate. Then on Monday and Tuesday, they kind of held stable. They improved a little bit. And then Wednesday, when the Federal Reserve came out, they actually worsened. So really and truly, when the Federal Reserve dropped a quarter point, rates actually worsened that day. And then today, we're seeing a little bit. Overall, this week, we're seeing some small gains of interest rates, but not a huge amount. Nothing to circumvent this dramatic drop. Now, if we look at rates over the past year, you can see the rates were worse November 8th. And that's when rates were hovering around the 5% mark. Since then, with all the recession talk, we have seen rates go up, the chart go up, which means that rates have come down. And that has been since 2 weeks ago, and then they've worsened a little bit. So kind of the moral of the story is just because the Federal Reserve drops rates and every bank CEO or everybody gets on television and say rates have dropped, it's just clickbait. It really doesn't mean mortgage rates have dropped. What's going to cause mortgage rates to drop is recession talk. Now, where are rates going? Nobody knows. We really can't figure out where rates are going. We barely can figure out where rates will be tomorrow on this one here. The trend line is pointing towards that rates are going to continue to slide downward through the next 2 years because we're going to head into a recession in the next 2 years. So everybody asks, what are rates going to be? Keep following us, follow rates. We're going to give you the best guidance on this. Now, when is it a good time to refinance? That is a great question. We at First Choice follow 2 rules. Rule number 1, we want to save you a minimum of 0.5 point on the interest rate. And that is without any points or buy down fees. There's a lot of people advertising like 2.99 today on a 30-year fixed mortgage, but they're charging you 3 points or 3% of the loan amount in order to buy that rate down. If you have a $200,000 loan amount, 2 times 3 is 6, they're going to charge you $6,000 in order to buy down that rate. So rule number 1, we have to save you at least 0.5 point minimum in order to do this. At a point, it makes it great. Rule number 2, we want to divide savings into closing costs. So if you're going to save $100 per month, but your closing costs are $3,600, 100 divided by 3,600 is 36 months, which means you're going to return your investment in 36 months on this. If you return your investment in 36 months and less, and you're going to save at least 0.5 point minimum, we feel that it might be a good option to look at it at that point in time. 36 to 48, that may not be a good decision.
you are going to have to see how long you plan on staying in this house and how much left do you have in the term to stay in this house. 48 and higher, it just doesn't work. It really, really doesn't. Now, like I said, there are lenders that will refinance you to save you a nickel because they're in it to make money. Don't get me wrong, I'm in it to make money too, but I want to make sure that it's the right decision for you, not my pocketbook. So, 2 rules. Minimum 1/2 of an interest rate or 50 basis points. Rule number 2, divide monthly savings into costs. It needs to be 36 months or less. Now, there are some exceptions to the rules, but not too many. So we encourage you to give us a call. Let us do a cost-benefit analysis. Let us see if it makes logical sense for you, because we're going to be in it for your best interest. If you ever have questions, please don't hesitate. Give me or anyone on my team a call. We'll be glad to give you the cost-benefit analysis and educate you. Thank you and have a great day, and go Broncos.